Hello, Mike and Jane. I'm going to be going over your Form 1040 with you guys today and explaining why you had a tax refund of $3,503 on your 2023 tax returns. So to begin, I'm going to go over your income. So you had a total amount of income from your W-2s of $190,000, and this came from Jane's salary of $105,000 plus Mike's salary of $85,000. And so from that $190,000, you also had some interest and ordinary dividends, and you had $2,000 of tax exempt interest. So this will not be counted towards your taxable income. And then you also had taxable interest of $3,200 that will be counted towards your taxable income, as well as ordinary dividends of $1,500. So when you take that $190,000 salaries and you add $3,200 of interest and $1,500 of dividends, you get a total income of $194,700. And from that total income, you had an adjustment of $1,300, and I will show you this on Schedule 1. So that $1,300 came from your health savings account, from Jane's personal contribution to that account. And I will show you why just that $1,300 personal contribution is deducted rather than that $6,000 payroll deductions. And so because of this, you have a limit of $77,750 if you have family coverage. And so we took that $7,750 and we subtracted that $6,000 employee contribution, and we get a total of $1,750. And then we also have the personal contribution of $1,300. And as you can see here, we enter the smaller of that 1,300 or that 1,750. And so because that $1,300 is smaller, that is the deduction for your health savings account. And so when we subtract that $1,300 from our total income, we get an AGI of $193,400. So from that AGI, we can take our standard deduction or an itemized deduction. And for you guys this year, we took our itemized deduction because it was much higher than your standard deduction would have been. And so as you can see, you had a total itemized deduction of $76,210. And I will kind of go into a little bit further detail of why and how you got the itemized deduction. So to start off with medical and dental expenses, there are a few expenses that you could include and a few expenses that you could not include as a deduction on this year's tax return. And so of that things that you can include, you got a total medical deduction of $42,010. And you got that number from $27,500 of Mike's medical expenses. And that includes the flight and that $25,000 hospital bill. And then we also can deduct that elevator expense, and we can deduct $10,000 from that because the elevator costs $15,000 and it increased the value of the home by $5,000. So for that deduction, we just take that $15,000 minus that $5,000 to get a total of $10,000 that we can deduct. And then you can also deduct your elevator maintenance and utility increase. So you had a total maintenance of $300, and also it increased your utilities by $30 per month for 7 months. And so we were able to include that number, and it was a total of $480 for both of those. And then you're also able to deduct Mike's wheelchair of $1,500. So when you add all of those medical expenses together, you get $42,010. And some of the things you could not deduct were Jane's plastic surgery, because you cannot deduct plastic surgeries or anything of that sort. And you also cannot deduct over-the-counter medications unless it is insulin. So we were not able to deduct that $500 either. So for that $42,010, we can only deduct over 7.5% of your total AGI. So as you can see, your total AGI of 193,400 times 7.5%, you get 14,505. So this number is that 7.5% of your income that you cannot deduct from your itemized deductions. So we take that total medical deduction and we subtract that limit of the 7.5 of our AGI, and we get a total medical deduction of the year of 27,505. So that's how we got that number. And then you can also deduct your state and local taxes. So for this year, Jane and Mike, you both had a total of $6,500 on your state tax withheld. And that came from that $3,500 withheld from Jane and that $3,000 withheld from Mike. Um, and so with that, and then you also had real estate taxes of $5,500 this year. So you get a total of $12,000 state and local taxes. However, the limit for the IRS is $10,000 that you may deduct for state and local taxes. And so we were able to take only that $10,000 deduction on your itemized deduction. And then you're also able to deduct your home mortgage interest, and you're able to deduct your full $7,500 of mortgage interest. And then you also are able to deduct some of your charitable donations. However, you're not able to deduct all of them. So as you can see, you got a total charitable donation of $31,205. And 800 of that was a non-cash donation to DI. And you're only able to take the thrift shop values. So that's why we have that deduction of $800. And then for our gifts by cash or check, you're able to include that $25 donation to SUU. And then you're also able to include $18,000 to the Utah National Department of Resources. And the reason it's $18,000 instead of $20,000 is because you bid $20,000 for the event. However, the fair market value of the hunt was $2,000. So we subtract that $20,000 and that $2,000, and we get a total of $18,000 that we're able to deduct for that charitable donation. And then you're also able to deduct that full $10,000 you donated to your church. And the last thing you're able to deduct on your itemized deduction for charity is $2,380 for your travel expense, and that includes flights, lodging, and your meals to Peru. However, you are not able to deduct your $3,000 services because the IRS does not count services as a charitable deduction. And you also are not able to deduct that $3,000 donation to the Peru school because it is not an IRS recognized contribution. And that goes the same with the homeless man and the family. You're not able to deduct those expenses because they also are not a IRS recognized charitable contribution. So with that being said, you add that total cash and non-cash donations, and you get a total of $31,205 that you can deduct from this year's itemized deductions. And so when you add that $27,505 medical expense, plus that $10,000 state and local tax income, plus that $7,500 mortgage interest, and that $31,205 gift to charity, you get a total itemized deduction of $76,210. So we take that money and we subtract that from our AGI, and that gives us our total taxable income of $117,190. So from that $117,190, we can go ahead and pull up our tax rate schedule. So as you see, this is a 23 tax rate schedule. And under married filing jointly, you'll see that you're in the 22% tax bracket because you make over $89,450, but under $190,750. So part of your income is taxed at that 22%, and anything under this number will be taxed at these lower tax rates. And so when you take that tax rate, you get a total tax of $16,397. And so from that tax, we can look at our payments we had. And so as you see, we had federal income tax withheld of $19,900, and that includes both Jane and Mike's federal income tax withheld. And so that came from that $13,400 from Jane and that $6,500 federal tax withheld from Mike. And so we take that $19,900 and we can subtract that from our total tax of $16,397. And as you'll see, we get our total tax of $3,503 that is refunded to us, that we basically overpaid that much money. And that is why we're getting that much back. And so if you'll see, you can lower your federal tax withheld next year and balance this out unless you like getting that big tax return. So I hope this made more sense to you and helps explain why you got that $3,503 tax refund to you. and I hope you enjoyed. Thank you.